Well, welcome everyone to CMI's Financial 102 training. My name is Kara Pusey. I am the Management Training Director for CMI, and I have actually quite a few managers from CMI on the call. I don't normally do this, but I'm going to introduce all of them just because I want you to kind of see their faces. So the first one that I have on my screen is Ben. He'll wave. Ben is one of our managers. Denise Bauer, our president. Seth, our manager. Laura Hall, our CIO, our Chief Information Officer. Heather, our manager. Sydney's down somewhere. Saw her a second ago.
I'm traveling. Hi, everyone.
Thank you, Sydney. So we got a few on here. We have quite a few also in other board meetings as we're wrapping up the end of the year. And I have asked Schwint and Co. to attend this and do this presentation with me. So I will introduce David Schwint and Carrie Barrett. They can say a little bit more about themselves if they like while I put up this presentation.
Well, Dave is my boss, and he's muted right now. But mostly with CMI, I work on financial statements reviews. I've been doing this since 2006. So I've worked on probably, if you've had a review and you hired us, I probably did it. I probably did the work. And I do also some consulting work for CMI associations. That's it.
Lost David. Did we lose David as a whole? Uh-oh.
He's on.
Is he? I don't see him.
He is, I'll ask him to unmute here real quick.
Okay, that's good.
Let's try this again. Hi, can you hear me now?
Yes.
Thanks. My picture was off to the side. I didn't realize I muted. So Dave Schwent, I've been working with, and our team has been working with homeowner associations for over 35 years. Our pleasure to be here tonight to share some information on finances and taxes and anything else that the participants would like to talk about. We are at your pleasure. So again, it's good to be here, and I'll give it back to Kara.
Thank you. So as I said earlier, if you are unmuted, if you don't mind muting yourself, just so that we can limit some of the background noise. Of course, Carrie and Dave, please, if you want to stay unmuted, that's of course okay.
Great.
So with Financial 102, our main goal of today is to talk about and review the CMI financial statement that we produce for your association, and then go further into talking about reviews, audits, taxes, kind of some of how that is important for you to know as a board member. And so in terms of the financial statement, we're going to talk about the balance sheet, the income statements, the ledgers, accounts receivable, accounts payable, just kind of all of those documents that are in the financial statement and what you should be looking for as a board member. I always like to start things off a little funny, so I put in a little comic. So we're going to start with the balance sheet. Just as the name indicates, their balance sheet should balance with your assets versus your liabilities and equity. So this is a clip of kind of a traditional CMI asset page. So you have here your current assets, and then we divide it up based on operating, reserve, and if you have other additional funds, those would be reflected here as the column horizontally, and then total across the screen. Then down here is your undesignated your designated capital and undesignated operating fund. So in this particular case, this association has under their operating a due from and to their reserve. So we'll go into that a little bit more later. I just wanted to point it out. I have a different slide on that. But here, what you're viewing is kind of how much cash do you have in the bank? Oh, it clicked when you touch it, sorry. Your accounts receivable at like a snapshot. So this accounts receivable, they also have this particular one has a doubtful accounts receivable, which is something that the CPA does. Dave, did you want to go into a little bit about the doubtful account receivable and how that's determined?
Yes, as you assess your owners every month, if that's the cycle you're assessing, those assessments are doable, are due within 30 days, or I guess they're due at the first of the month. And if folks don't pay their assessments on time, then your assessment receivable account is just going to keep growing, right? And some of you have probably noticed that over the years that folks are not paying their assessments, so that assessments receivable amount is growing, and that can affect your cash flow, right? Sitting there as an asset, but it's not in cash. What auditors do at the end of the year is that we determine which assessments are in danger of not being collected. Now, for homeowner associations, there's an automatic lien placed upon the individual as they're billed. So you don't have to be liening folks all the time. But on the other hand, if folks are in financial straits, if their units are in foreclosure, if other issues are present, then as auditors, we will recommend an allowance for doubtful accounts. And what that does during a given period is it charges off the revenue that was previously recognized when we assessed the members to bad debts. So we're basically taking the revenue out of your income statement in the form of bad debts. So it gives us a better picture of what revenue is ultimately going to be collected from the members. Does that help?
I'd like to add something.
Please.
Go
So,
ahead, Gary.
sure. So in this case, your doubtful accounts balance is greater than your accounts receivable.
I saw that.
So in my job as the reviewer of these financial statements, I would be asking a question such as, why, first of all, and I would look for something such as maybe some accounts were written off and they were written off to bad debt rather than to the allowance, or perhaps the association received a payment on some receivables that they didn't expect to previously. There could be a few reasons, but those are the two most common. So if this association is going to get a financial statement auditor review this year, I will definitely be asking about the doubtful accounts. Mostly,
Also,
go
it
ahead.
could also be that that was a year-end adjustment for the doubtful accounts receivable, and it hasn't changed. So as we're collecting the amounts, that account wasn't adjusted during the year. Does that make sense, Carrie?
Sure.
So at year end, of course, we're going to take a look at receivables and the allowance for doubtful account and adjust it as necessary.
Okay.
Great. That's doubtful accounts receivable. So then underneath that, we have prepaid insurance. Most insurance policies are some of the policies are paid in full at the time that the policy is bound. Some you pay a deposit on and then you have a monthly charge. So we put all of that into prepaid insurance as an asset for the association because you've paid it in advance, but you haven't used that insurance yet. And because you can cancel your policy at pretty much any time, it just depends on the carrier. There's a potential you could get some of that money back, and so it is an asset to the association. And then every month we take 1/12 of the overall premium of the policy, and that's what we log into the financial statement. So that's what you'll see in the income statement. And then down here you have, this mostly would be if you had income for, so your reserve is over here for the designated capital. We consider the reserve capital fund. And so that's down here in the tracking. I have another example that has multiple, so we'll take a look at that in just a second. But we're going to flip over to the other side of the equation of the balance sheet, which is the liabilities and equity. So here you have your accounts payable as a current liability. These are going to be expenses that we have received the invoice for, but they either haven't been paid out or they're pending being paid out, and so they're written as an account payable because we know they're coming out. They just aren't fully reflected yet. Prepaid AR, this would be accounts receivable that has been paid in advance, and so we log it as a liability for the association, as if for whatever reason the association was to dissolve, that would be money that's owed back to the homeowners as they have paid in advance. Insurance proceeds payable. I picked this particular one because it had it. This is where we would reflect kind of the collection of an insurance claim. So this particular insurance claim is running a deficit of $2,854. So as part of the review, I'll let Carrie talk or David talk to what they look for the insurance claims. But in terms of reviewing the financial statement, we want that to either be zero or know what's going on. Are we waiting for more expenses to come in, more money to come in from the insurance carrier? So that line item is used to track kind of the pluses and minuses of an insurance claim.
Comments, Carrie?
My
It
comment
looks
would
to-
be that it's negative, which indicates that the expenses for this particular claim, as of the date of this report, are more than the proceeds that they've received.
Yes.
If
Well,
this,
This particular one has been
isn't it
resolved,
just the
but yes.
opposite? Isn't it just the opposite? Because we've got money in debited cash, right? And so it's liability. Okay, that's right. So we haven't paid out.
right, this we would propose an adjustment if this was a year-end report, because expenses are required to be reported in the year that they occur. So we would be asking questions such as, was the claim settled as of this date? Or are you going to receive more? Are you going to have, is this all one claim? Or maybe there's a couple of different claims going on? We ask a lot of questions about these accounts. Sarah's nodding, so yes, she knows. It's really a good idea to keep track of each claim separately, so.
Yes,
And
and we do have that set up now to where we can track them all under different account ledgers, and so we
Right.
can see them and going through, which is great and easy for all involved. But it's definitely something to keep an eye on. Now, Carrie, I might have you stay unmuted for this one because contract liabilities is one of my favorite things to try to explain that I never do well. So this is the liability of the association. It contains a couple of things depending on the association, but basically it's a long-term liability. For the most part, it's your reserve, maybe some move fees. It's basically expenses that you've collected money for that haven't been expensed yet. So it's planned that you're going to replace your roofs. You've started collecting money for your roofs. You're going to spend that money to put it on your roofs, which is why it's a liability of the association and not equity. Is that close, Carrie?
So there was a revenue recognition.
We're going way back.
Yeah.
Sure, yeah.
So I think it was 2019, maybe
But
2020, where there was a requirement for revenue not to be recognized until it is matched with the intended expenses. So everybody's fund balance moved from, if you've been in an HOA a long time, it moved from the members fund balance section, their members equity, up into this long-term liability. This is a GAAP, which is generally accepted accounting principle. This is a GAAP requirement at this point, starting 5 years ago. So basically, it's all of your leftover contract liabilities, which are member assessments, anything that is required to be charged to members per the governing documents, minus everything that's been expended. And these expenses in your reserve fund are, things that you have budgeted for in your reserve study. So if an expense is not in the reserve study, then it goes into the operating fund. So this long-term liability is designated for future expenses that are listed in your reserve study. In other words, they're deferred. They're a deferred income. You cannot recognize them as income until the expense occurs.
Another way to look at this is in the past, and board members, you've probably seen this on your income statement. In any given year, the reserve assessment portion of your total assessment was recognized as income, right? Showed up as income on your replacement reserve income statement. And there may or may not have been any expenses that year. So in any given year, you could have a major loss or major net income in your replacement reserve, which we frequently had questions. It's like, what are we making money on reserves, right? If you have more income than expenses in a given year. What this does is for every dollar that you assess for reserves, it basically goes in this contract liabilities account until you spend it. When you spend it, then it's the income and the expenses are both recognized on your income statement. So in any given year, there are some reconciling items that differ for this, but you're going to break even on your replacement fund. You're going to recognize the income and the related expenses for what you paid into reserves to match with expenses. Does that help? And there are differing opinions on whether or not this applies to HOAs. As a firm, we have decided, and the AICPA has decided that it applies. So that's what Carrie said, is that that is the accumulated amount that you've assessed your members for reserves that haven't been spent yet. That's it. How's that?
Perfect. Yeah, it works. All right, so that's kind of some of the generic liabilities, and then equity, right? So that's the other part of this side of the equation. It would be, in this case, as we talked about, your reserve is an equity of the association. This is where we're going to see the operating fund, kind of the, what money you might have available on your operating side. So this top number up here, the 3145 undesignated operating, this is the accumulation since the beginning of time of the pluses and minuses of the operating account. So this would be what we would consider available money in your operating fund. Now, there's a caveat to that, which I'll get to in 2 seconds. Underneath that is the net income from the year-to-date, income versus expenses on the operating side. So this particular association, income versus expenses, is running a negative of $14,000. The good news is they had an accumulation of $27,000, and so they had a little bit of wiggle room. Now, it might be that as they progress through the remainder of the year, that net income will reduce from being more expense heavy, or it might get bigger. That's something to keep an eye on as a board member. That's one of the first things that I look at when I'm reviewing a financial statement for an association. I look at whether or not the balance sheet balances, and then I look and see how their operating fund is doing. And if they have a due from operating, why do they have a due from operating? Is that based on just a cash flow? Or is it based on maybe a problem that we need to address? Maybe a coding error. We might have put something on the operating side that should have been on the reserve. Fortunately, accidents happen. The good news is we can fix them for the most part. Here is another example of a balance sheet, and I wanted to show this one because it had more funds. And so that the horizontal, the columns here, so you have your operating fund, reserve fund, a special assessment fund, and then working capital. And I know working capital is on your list to go through, so I'm not going to talk too much about working capital at this point, just to let you know that it is a fund that some associations have. So those are kind of the different funds. We have other associations that have multiple operating accounts, multiple reserve accounts. Some will track special projects through different funds just so that they can, see what the expenses and income are associated with a particular project. And so we can set up funds based on that. If you have a question relative to if you need to set up a fund, just talk to your manager and we'll work with our accounting team to see what the best option would be. Due from and due to reserves. So I had the example earlier where that association owed $700 from their operating to their reserve. So their operating was over on a cash flow basis for that association because they, as you saw, they had money in their operating account. They just also had prepaid insurance and a few other things that were causing a slight deficit in available cash on the operating side. And so that's just something to look forward to. If you're reaching the point where you're doing your budget and you're running a great deficit in your operating, where you're borrowing, a significant of any amount from your reserves to pay operating expenses, the Oregon state statute requires that you set up a plan. Well, Washington does too, by resolution to pay that back within a reasonable amount of time. Now, I will let you determine what that reasonable amount of time is, but it's very important that it is done by resolution, and it's part of that whole budgeting process. So it's something to look at when you are doing your budget, which I know we've probably already done all your budgets, but next year. And I think, Carrie, you look at that as part of the financial review, right? An audit?
Do I look at the due to from reserve
Mhm.
accounts, you mean? Yes. So we looked, that's something that's reported on balance sheets. And if there's like a reclassification of expenses or something between the different funds, that may change during the reviews or audits. We like to see that the association is keeping track, and we will look at the subsequent year's budget to see if they have a plan, especially if that interfund balance has been growing over time.
Sometimes it's a surprise at year end when we prepare our financial statements that there is a large due to from. And the question is, wait a minute, where did that come from? Right? Because it means that if it goes that way, if the operating fund owes the reserve fund money because the operating fund has been borrowing money from reserves to pay operating expenses, then that's when you need to come up with a payment plan. But the thing to remember here is that this could happen every month. So it's something to look at, talk about every month, just to track it. Because what it tells you, if you're constantly borrowing from reserves, is that budgeting may not have been adequate for the year, or there could be some special circumstances that need to be addressed.
Exactly. Yes. That's checking that you're budgeting, or, sometimes it's simple as, yes, we knew we had to spend that money on this one-time expense. So it
Mhm.
caused us to be over, and then we just need to build a plan to pay ourselves back for that. Otherwise, you'll start having issues with not having enough money in your reserve because your operating has taken too much money from your reserve. And the fund balancing act. Now, the other thing I wanted to show with this particular one is a loan. So this association has a loan. Oh, I just clicked it and I can't do that. That is going to be one thing. So this right here, the loan, Northwest loan, it's one way to kind of keep an eye on how your loan's doing. It is a long-term liability of the association, as you will have to pay it back. So you can kind of see how your loan is slowly decreasing every month. All right, any questions? You can jump in at any time and ask questions. Okay, I'm just going to keep going. So that's the balance sheet. So that's the first page or pages of the financial statement. The next pages of the financial statement are the income statements. This is going to be broken up by fund. So we have the operating fund and the reserve fund, and then any other funds that you had on that balance sheet are all going to have an income statement. The income statement is going to be for that month. So we call that the current period, and then year to date based on your fiscal year, and then the annual budget. So this gives you the comparison of month, year to date, and annual, so that when you're reviewing how your operating is performing, your budget is performing compared to your actual cost, you can kind of see it those three ways. So when I'm reviewing an income statement, I'm reviewing it to see about variances. And I do look for both sides of variances. I look for both the high positive variance in terms of you haven't spent enough budget, and I also look for the other side, the overspending of budget, and try to kind of figure out why. One of the most common would be maybe a coding error. Maybe it got put on the operating side instead of the reserve, or on the reserve instead of the operating. And you just need to let us know if we haven't caught it already and have that adjusted. We do want to adjust those as soon as we see them, because we do close our financial statement. And once we close it in December, CMI will not make any further edits. We would then have to send any edits that we see to the CPA to further make changes. So that is definitely something to keep your eye on and see if there's any coding errors. Like I said, we do try our best to keep an eye on it as well. This particular association has some serious irrigation issues. They're $5,000 over in irrigation. So I know this is going to be a question that Carrie will ask me when I get the financial review. And I know why. The board approved all the expenses and we had a lot of broken irrigation lines.
I would probably also ask about that negative legal expense. What would your explanation be for that?
For legal, why is there a negative legal expense? That's a good question. I would have to review the GL detail to kind of see what happened there. Was that an adjustment that my wonderful CPA made that caused it to do kind of weird things? Or did, yeah, that's a really good question. Now I'm going to have to look at this one and figure out why.
Don't blame it on me.
Could be that a journal entry was done wrong. I mean, we are human. We make mistakes. That's why so many people review these financial statements. And it's important as a board member. It is part of your fiduciary duty as a board member to look at these financial statements. You know, we do our best to make sure they're as completed as possible. Okay, I think I have a reserve one. Oh, nope, I go more into reviewing expenses.
Excuse me. Excuse me, I was wondering if we could go back to the prior.
Yep.
Yeah, I want to ask a question about that. So when I'm looking at the rows, and I see, like, let's go down to, let's say, just, I guess we could start with electric. And you get to, let's say you're at the row that's like not the first box, but the second box over from electric.
Right here.
So you're on the electric line 6060.
Oops, sorry.
And then you go over to the second box. Yeah, that column there. Okay. So that's the actual amount that they spent for the month. Is that what that is?
So this would be the actual amount spent for the month, which was $0. This particular association, their electric bill is only quarterly. So there're going to be a few months where we don't have any bill that's going to hit the monthly amount. And then this column right here is the year-to-date actual expense. So they have spent
Gotcha.
year-to-date $52.31 as of August.
Okay. And so, and the annual budget is $168. So they $168 total for the year?
Yeah, so this is like tiny little irrigation electrical. It's not a lot.
Okay.
This is a single family homeowner association that I stole from. So they don't have a lot of electrical problems. They got
Gotcha.
a lot of irrigation problems, but not electrical. So yeah, so this would just be the electricity used. The first few utilities are strictly just utilities. So this is their electrical use.
Okay, thank you.
What I like too about this comparison for financial statements when I'm reviewing, I look at things on a monthly level, mostly for coding errors. I look at things on a year-to-date level to kind of see how the budget is performing with actual expenses. But I also review it with the annual budget and kind of see, you know, because there are some line items that, you know, kind of maybe only have an expense happen once or twice a year. And I just want to see how we're performing overall. And so I kind of look at both of those to see how we're really performing budget wise. Because it might be that, I mean, irrigation's a bad example for this one, but let's just say the budget was closer to the actual. And I'm looking at comparison, I could be like, okay, well, we've spent, we'll just say $500. We have a budget of $500, but I know there's not going to be any more irrigation expenses. So even though it may look like it's over budget, it's not over budget for the year.
So where it says budget and it's like going back to the electric line where it says $112. So is that how much you've spent year to date?
So this is how much has been budgeted year to date. So this particular association is a calendar year financial. So this would be the 8th month of that financial. So we have 8 months of the $14 as the budget year to date.
Gotcha. Okay, thank you.
Hey, Kara.
Yes, Lee.
Yes, yeah. I've got a question for you. On speaking about irrigation, we did have a leak and I caught it and I sent off a letter to Tualatin Valley Water District. Now they're supposedly going to give us, you know, some money back on that. Now, how do you, and hopefully I get it. I don't have it yet, but if we do get it, how does that apply towards the, you know, because it's an operating expense, it's on our operating budget.
So it would be recognized as operating income. And we would make a separate little line item over here in the revenue section. Or we would, because this is offsetting a invoice that we had received and we're getting a credit, the other way, because that's likely how those are issued, we would basically credit that water line item where we expensed the invoice. So it would be doing like a credit memo.
Oh, okay. All right. I just wondered, and do I get a hold of you right away when we get it? Or do I just go through Mac?
Yeah, get old Mac. Mac will take care of that for you.
Okay.
Yeah, so it's likely what the city of Tualatin does is they just issue a credit onto your invoice. And then you don't pay water for however long until your credit's used. Typically how those occur.
I
I've
don't
seen
know.
it once where they've given us a check, but most of the time they just issue a credit.
I've never done this before, so I don't know. We'll soon find out. Thanks.
Yeah, I've done it a lot recently for some reason, but yes, normally they issue a credit on the invoice. I've seen people do weird things though, so who knows? But yeah, if they end up giving you a check, just get it to us and we'll process it.
Kara, this is Debbie.
Hi, Debbie.
Hi. Hey, I'm looking at our statement here, and is this just operating? Because we had in the heat pumps, for our heat pumps, we had $500 budgeted, but we spent $6,961, which obviously should have come out of reserve. Does that show up on this?
Now, Debbie, for your financial statement, if you recall, we made a lot of adjustments, and I think a lot of those adjustments were done in October. So the adjustments will be reflected in the month that they were done. So when you get your October financial statement, you will see a lot of adjustments done.
Okay,
I did a lot of fixing of yours.
okay. Thanks.
Now we'll have to double check the date. I'm 99% sure we did that in October.
Okay. Yeah, this is a September one, is the latest one I have. Okay,
Yeah, and that's the other thing too. Our financial statements are produced later in the month so that we can try to catch as many actual expenses that occurred for the month that we're doing the financial for.
okay, thanks.
The one thing I want to point out here too in reviewing income statements is, you know, and actually I'll go back to this one here. So not only am I looking at expenses, expenses are super important, very important to pay attention to. But if you're an association that has a lot of different income line items, such as if you have guest suites or different things, rentals of some kind, I kind of also pay attention to those as well to make sure that income is coming in and that you know, everything's being accounted for correctly, but also in the sense of looking at how much income have you received year to date actual versus how much expenses you have had year to date actual. And then where does that actually net you? Because comparing expenses versus budget puts us over budget $5,554. But if I compare actual income versus actual expenses, we actually have a profit of $1,605 for this particular association because we had additional miscellaneous income from, I can't even think of what that would be. Oh, it was late fees or fines. This particular association has a lot of fines. So they had a lot of extra income from fines, which kind of put them in a net positive overall versus income versus expenses. So that's something else that I look for when I'm reviewing the financial statement. So following the balance sheet and the income statements are all of the reports that further explain the different line items on the first two reports. So the balance sheet and income statement is the abbreviated financial statement that we put out to everyone. The board, you will get the full financial statement, which could be 40 to 100 and something pages, depending on how long your general ledger or GL detail is, because it's every transaction that is made during the month. Now it's only for the month, but still it's the 100, could be 100 pages. So it just kind of goes through, it goes through, we have one for the reserve and then we have one for the operating for the GL detail. And that's going to be every line item that hit that month. So if you are looking at the income statement and you're like, what did we spend $500 on? You can go to the GL detail under that line item and see what you spent $500 on. It's going to give you the date, and the what we call ledger ID, which will translate to the check register, which I'll show you in a minute, and then the description, and that's going to have the vendor, the invoice number, and then the amount. And so you can take that invoice number and go into Strong Room and actually pull the invoice, so you can get a little bit more about it. So now I'm going to flip over to the AR aging. So we do two reports for AR. One is, of course, your delinquency report. This is going to tell you kind of broken up page by page on how the delinquencies are separated out, and then it does it account by account. And so this particular association doesn't have too much delinquency, thankfully. And then kind of what each owner owes that way. And then whether it's current, which is 0 to 30, a month past due, which is the over 32 months past due, over 60, and then over 90, and then beyond. So anything over 90 days.
This report also has usually some kind of note if there's foreclosures or bankruptcies. And this is the report that the CPA would look at to make, to compare, total bankruptcies or foreclosures with the doubtful accounts, to make sure that the doubtful accounts balance on the balance sheet that we were talking about earlier is reasonable or not.
So that's that collection status right here. So this, I'll pick a better one next time, but this particular association just has one where it says the collection status. It is for that particular unit is on a first notice. So that means that we're going to mail them a statement saying, hey, well, here's your account balance. You haven't paid, please pay. It's just a mail billing statement. And then if they don't pay, we get a reminder to look at the account. And then we either discuss with the board or we'll turn them over based on the collection policy for the association. And then once they get turned over, this will change to with attorney, and then it does little updates. One of my favorite ones is if they're on a payment plan, it will be reflected here as well. So you can kind of track some of that as well and see the status of some of the AR. Some statuses you're going to have to get more from the attorney than from the AR report. And then the other AR aging report that we do is the prepaid. So this is where we would be able to see who has prepaid their account. Whether we actually have quite a few people who pay the whole year in advance, more than I thought, but I did a little research not too long ago and found out that there's a lot that actually prepay in advance. So these reports will give you the snapshot of collection and who's past due and who's prepaid. This is the AP aging. So on the liability side, there's the account payable. So this shows you everything that is pending for accounts payable. So all of these have been received. They just haven't been paid out yet as of the time that this financial statement was snapshotted. Cash disbursement, this is going to be all of the payments that are paid out. So like I said, there's a, this will have like the invoice number and kind of some of the coding and line items there associated with the different expenses for the association. So it's kind of like a check register kind of thing. Bank reconciliation, this is where we kind of go through and balance each of the bank accounts. So you'll see in this particular association, there was a few items that were not cleared. Just means the checks have been issued, but they haven't been cashed. So we can keep an eye on that because as they start to get closer to 90 days, they become invalid after 90 days. And so it might be that we need to reissue a check, figure out if it got lost or something along the lines. But it's what we use to keep kind of the reconciliation of the bank account and where everything is. And then further on, it gives you even more detail of the bank reconciliation. Bank statements are the last part of the financial statement. Pacific Premier will be there, and then any other banks that the association has money at will be included as they are provided. So some banks will send us statements. Some bank statements we have to collect from the board. So it's super important if you are a board member and you need to get us statements, if you can get them to us as often as they are available. Some statements are only available quarterly, especially like on CDs and certificate of deposit, CDRs. Some of those may not be available every month, and that's okay. We just need them as often as they are available. And we definitely have to have one at year end. So if we don't get any other statements, we have to have the year end one. Okay, that's kind of the reviewing of the financial statement. Are there any other questions relative to the financial statement? Okay, Carrie, do you want to, and Dave, do you want to jump in on talking about reviews and audits?
Would love to, if as we go through this, if there are any questions, just let us know. And Carrie, as I go through the first couple of bullet points. If you have anything to add, please just chime right in. Before I get
Yeah.
into the difference between audit and reviewed financial statements in Oregon, if you have assessments in excess of 75,000 annually, then you're required to have a reviewed financial statement. In Washington, there's an audit requirement for condos that have greater than 50 units or HOAs that have 50,000 and above and assessments. So what's the difference between an audit and a review? Most of our clients, of course, have reviewed financial statements. Most of our Oregon clients and all of our Washington clients that meet those criteria would have an audit. Audit is the highest level of assurance you can receive from your CPA. Includes an evaluation of internal control strengths and weaknesses. And that means, do you have proper approvals, documentation of those types of approvals, and documentation of transactions. And an audit, of course, we're looking at variance analysis, review of minutes, and we also, when we can, will confirm cash directly with the bank in writing. So the evaluation of internal controls and confirmation of cash at the bank in writing are two of the main differences between an audit and a review. As well as an audit, we would, in more cases, trace transactions to supporting documentation to get further verification of the transactions. In a review, it's more analytical. Variance analysis is important. We always trace balance sheet information to supporting documentation. And Gary mentioned a number of things we do with receivables and allowance for doubtful accounts, variance analysis on the income statement. So if you were to just capsulize the difference between an audit and review, audit is much more in-depth. It's the highest level of assurance you can receive from the CPA. Review is a lesser level of assurance, although it does contain a lot of analytical procedures. In an audited financial opinion, we would say that we believe, if we do believe, that the financial statements are fairly stated, we state they're fairly stated. In a review, we will state that nothing came to our attention that would lead us to believe that the financial statements are not fairly stated. So you see the big difference there. And of course, the price of an audit and a review is reflected accordingly. Any questions on the difference between audit and review? There are some reasons why, if you're required to have a review for statute, why you might want to have an audit performed. One reason would be you've never performed an audit. You've never taken advantage of that added level of assurance, and an audit would provide. Another reason would be a complete change in the makeup of your board of directors. You have clean slate coming in. The new board might want a higher level of assurance that they're starting out with accurate records. And of course, if board members have questions on transactions or perhaps some improprieties with maybe a treasurer that has left, and there are some questions on how that treasurer was handling finances, that might be a good reason for an audit. Questions on
Dave,
that?
we do have a question, Eric.
Hi,
Yes.
hi, Dave. This is Eric in Columbia Shores in Washington.
Hi, Eric.
Hi. So you said that the requirement for an audit in the state of Washington is how many units?
50.
50. Okay, so Carrie, so we get an audit every year then?
In Washington?
Yeah,
Yes.
you get an audit every year. You have almost $1 million budget.
Okay, great. Okay, thank you.
Absolutely. Okay, next up is a fun document that the associations deal with every year when they have a review or an audit performed. And that's
Dave,
pardon me?
So here's the question that I am asked most of the time when I'm doing a financial review or audit. People
Yes.
say, we don't know any of this stuff. We just let our management company do all the work. I don't feel like signing this really big, giant legal document. What do we say to our clients when they have that question?
That's a good question. And the answer is, even though the board, acting on behalf of the members, will farm out the duties that they're responsible for. If you look at your CC&Rs, the board is responsible for certain duties, keeping accurate records and presenting that information to the board and the membership. The board can farm that out to a community management company and form an agency relationship with the management company. But the ultimate responsibility and authority rests with the board. And so as auditors, we know that the buck stops with the board. And that's why, even though at the board level, you're thinking, wait a minute, why would we have to sign any assertions with our responsibilities with the financial statements when we farm that out to our management company? And that's why. How's that for an answer, Carrie?
I like it. That's
Alright.
why every single board packet that goes out, carefully prepared by Kara Pucci, needs to be actually reviewed by the board. And the questions and any, changes or whatever should be asked of the manager. And
Oh,
the draft letter says, basically, as far as we know, to the best of our ability of knowing, this, these are our assertions. So as long as the board has, actually been paying attention and have asked questions and got an understanding of this, then that's basically what the rep letter is
Right.
telling people.
And it talks about responsibilities and the assertions
Yes.
of the board. Now, here's a question, Carrie. What if a board member or a new treasurer was not on the board and was not an officer last year, and that's the year that we're auditing or reviewing, and so the representation letter is all about last year, and the new treasurer wasn't even on board, wasn't even on the board, can he sign that representation letter?
Yes, that person can sign the representation letter.
Yes, because think about this. Think about publicly traded companies. Boards change all the time. They're not going to go to their auditors and go, wait a minute, I wasn't there last year, so I'm not going to sign. When you take position, when you're in a position of authority, like a treasurer, an officer of the association, you also assume the responsibility of following through with the audit review. And so it is appropriate. And so if that wasn't appropriate, what are we going to go back to the prior treasurer and hunt him down and have him sign this document when it's not on the board anymore? I can assure you that would be a tough sell.
Yes,
So,
and actually the actual exact words are, we signers represent to the best of our knowledge and belief, and having made such inquiries as we considered necessary for the purpose of appropriately informing ourselves as of the date of this representation letter.
Right.
So, if you have questions, you should ask them, and it's okay to ask questions.
and I've suggested to officers that have been designated to sign the rep letter that if any place throughout that rep letter you want to emphasize that fact that it's to the best of my knowledge that this is the assertion, I'm fine with that because that's the assertion you're making. So even though CMI has an agency relationship with their clients, they are responsible for certain duties, right, that have been delegated to them. They sign a form of a representation letter as well. So it's not just the board that is making assertions. CMI is making certain assertions as well. So, and here's another fun fact to know and tell. You'd think, hey, Schwint, why did you write this letter that we have to sign the way that you did? And the answer is, we didn't write that letter. That's the AICPA that writes that letter. And if we don't, here's another fun fact, if we don't get that letter signed by appropriate parties, then we're not able to issue the financial statement. So sometimes that can hold up. Yes, I'm so sorry. Let me get rid of that. That can hold up the issuance of financial statements. So it is an important document, and the best way to look at that is it's a hot potato. As soon as you get it, deal with it, get it back to us so we can issue the financial statements. And it's not unusual. It has happened in the past. The boards changed and nobody knew who was going to sign it, and so the financial statements don't get finalized. And so you don't want that to happen. You want to go through this process, get it done, and get the financial statements finalized. So that's any questions on the representation letter. If you do have, or any of your board members that aren't here have questions, you can always call us and we can walk whoever has some anxiety over signing it. We can walk them through that process. Next up, income taxes. I'm turn the page for it. I think I've made notes. So here's a question for board members. Why are you paying income taxes anyway? Aren't you a not-for-profit? Who wants to answer that question?
That's a very frequent question. I do have.
That is a frequent question. So here's another fun fact to know and tell. You are filed under the not-for-profit statutes in the state of Oregon, but in reality, you're a C Corp, just a regular corporation in the eyes of the IRS. So there's a difference between how you file at the state level. That was just a place setting when the state was wondering where in the world are you going to have these condo associations file their documents within the context of the state statutes, and that's where they decided to put associations. In the eyes of Uncle Sam, you're a corporation. So as a corporation, you are liable for taxes on certain types of income. So you're not going to pay taxes on regular assessments, right? Well, that is right. You may not know that, but that's right. But there are certain income items that you may pay taxes on. Interest income is a very common income item that you're potentially taxable for paying income tax on. Club rental, right? Any types of income that you receive that isn't assessed to the entire membership are potentially taxable items. Clubhouse rental, laundry room income, that type of thing. Now, each one of those, including interest income as your good tax accountants, we find as many deductions as we can to net against the particular potential tax income item to help reduce your eventual tax. Now, many of you may have noticed that you're paying taxes this year when in prior years you didn't. And the reason that you've probably already realized this is that interest rates have jumped up. And so a lot of associations pay more attention to investing their money, and interest rates were 4 or 5% for the entire year of 2023 and through. I think they've come down now, but for at least the first half of 2024, they were still up 4 or 5%. So if you think about it, it's good news. Even net of taxes, you're still ahead, right? If you're earning interest. So that was the main catalyst that we saw this or for 2023 for associations having to pay taxes, and in some cases they were substantial. Now, let's talk about Revenue Ruling 7604. Before we get into that, you need to know that associations have the option of filing Form 1120H or Form 1120 every year. Form 1120H, and it's all under the auspices of being a C Corp, right? So you just have the option of filing a very simple 1120H one-page tax return, or the same tax return that publicly traded companies file, Form 1120. So if you're filing Form 1120H, it's because you don't have a lot of taxable income. If your taxable income is, $5,000, $10,000 net, then as your tax accounts, we would consider filing Form 1120 instead of Form 1120H. The difference in those two forms, other than the fact that Form 1120 is a lot more complex than the very simple Form 1120H, is that the tax that's owed on Form 1120H, the tax rate is 30% on net taxable income. Form 1120, it's 21%. So you have a 9% savings from switching to 1128 from 1120H to Form 1120. So that when you have $50,000, $75,000 worth of interest income, and I'm sure you're thinking, gee whiz, we should be that lucky, but some associations do, then that can make a difference. So that brings us to Revenue Ruling 70-604, right? Probably, I would say one of the most misunderstood aspects of understanding the relationship between Form 1120H and Form 1120. When you're filing Form 1120, we're going to switch gears and just talk about Form 1120, you are potentially paying tax on not only the items that we mentioned, interest income, clubhouse income, those types of things, but you're potentially liable to pay tax on your total assessments less all of your operating expenses. Now, and I'm not, this could be a whole seminar in and of itself, but Revenue Resolution 7604 allows associations to apply this year's net income on the operating side to the next year. It's like a 1-year deferral, and it gives us a chance to deal with that in the next year. So one of the commonly misunderstood issues with making a 70-604 election is that you have to do something then other than just making the election. You have to apply the excess revenue over expenses to the next year through a budgeting process, or you have to refund money or anything. You don't have to do anything. You just need to make the election, and the election is made at a duly organized annual meeting. And if over 50% of the folks that are seated at that meeting, once you have all the proxies counted and you have a duly authorized meeting, then you have folks that are sitting in that meeting. If 50% or more of those people vote affirmative to the 70-604 resolution, then you're done. You really don't have to do anything else. So that's one thing to keep in mind. We get questions. I'm sure, Carrie, you get lots of questions about that. And I see people doing things that they don't need to do. What that does, a good way to look at that is it puts us in a position to use that election if we decide to file Form 1120. If you're filing Form 1120H, you don't have to worry about anything in terms of the 7604. So another question is, if we're always filing Form 1120H, why are we even doing that 7604 election, right? Isn't that a good question, Kara? You get that. And the reason why is just in case. What if during the next year, Comcast comes in, wants to pay you $100,000 to put some lines in, or just to do whatever they want to do? That's potentially taxable income for that year. And so it would be good to have that 7604 election made the prior year that covers the year that you receive that money. It's a little insurance policy. And if you were to come to me and you're a very small association, and there's no way you're ever going to have enough taxable income to cause you to pay the extra tax fees in preparing Form 1120, because it costs more to prepare that more complex tax form, I would say, yeah, if you don't want to do that, fine, but you're taking the risk that something might happen that causes you to receive income in a year that you might want to use that. Does that make sense? That's all. That's all I'm going to say about that. Because we get into that just about every year. Terry, do you have anything to add on that?
One thought I was going to say about taxes
Mhm.
is some tax items, taxable income, you might want to consider as soon as you know you may have it, such as maybe there's a unit owned by the association and they're going to sell it. Or maybe the association foreclosed on a unit, they might sell it and there might be some profit. Um, Again, like if you're going to consider maybe putting a Comcast tower on your building and you're going to get a bunch of income, you need to be talking to your CPA about these types of taxable income as soon as you know about them, because there's some planning and things that can be done. So that's all.
Absolutely. That's such a good point. Case in point, when you're filing Form 1120 versus Form 1120H, transactions between the association and members are non-taxable. So if you're selling a unit to a member, if you're filing Form 1120H, you're going to pay tax on that income, the net gain. But if you're filing Form 1120, you can exclude that income. So we've had instances where associations want to sell a unit, and my advice is find a member first. An investor member and sell it to them. Association won't have to pay any tax. There's another point that emphasizes Carrie's very good suggestion is if you have money coming in from an easement, Comcast easement, right, for cabling or something like that, there are ways we can structure that. So we can structure it. Well, the truth is, in a condo, money coming in like that, the owners, you probably already know this, board members, that members own pro rata all the common area property. The condominium association itself doesn't. They just have maintenance responsibilities for common area. So what we can do with an easement is take the position that that is money that is not going to the associations, because the association isn't granting the easement, all the members are, right? Does that make sense? So that money that rolls in really doesn't belong to the association, does it? It's not their easement. It belongs to all the members. So we can structure this by telling the members, hey, you have this money rolling in, yet we're not gonna, the association wants to keep that money for all the good things associations do with that money, right? So they don't want to write a check to all the members. Members don't have to pay tax on it because they can reduce the tax basis of their particular units. Okay, so there's no tax effect to the member side, and then the association can instantly special assess the members for that money to be able to keep it. I've just given you about 2 hours worth of a tax planning session. The point to remember is you're selling a unit. If Comcast contacts you for an antenna or an easement, contact your CPA immediately so you can start the tax planning opportunities. Because if you're going to do this type of tax planning, you can't wait until the next year, right? When we're looking at your financial information for a review and an audit, preparing the tax return, and it's, oh, by the way, we received $200,000 for an easement. Too late to structure that so it could be tax free. Okay, so thank you for that, Carrie. Where are we at? We're at
Hey, David.
yes.
Yeah, I've got a question for you. We just had our homeowners meeting here last month,
Mhm.
and we voted to, I don't know if it was 1120, 1120H. We voted, we had over 50% to go ahead and get the tax reduction rather than going 30%, be it 15%. But we have a very small association to where we're getting taxed because we come in under budget rather than over budget on the operating budget. So I don't know what it is that we all voted on and signed, but anyhow, it's for a tax reduction. But why would we be getting taxed anyhow?
What was do you remember what your total interest earnings were for last year?
That wasn't very much, no.
Okay, then you should be getting taxed. unless you have other types of income rolling in that
No,
we need to talk about. But that revenue ruling that you voted for, it's
Yeah.
not, it's not an election that has anything to do with tax rates. It's an election to apply a specific revenue ruling. And
mhm.
you want to file Form 1120. So you're not filing for any tax savings or any tax rates. It's to apply a specific revenue ruling to your association in case we want to use it. So in
Okay,
your case,
another question for you.
Yeah.
Where do I find the number that has to do with the taxes? Where is that gonna be in my income statement?
there should be a line item for income taxes on the accrual basis. It should be on if you paid income taxes, and old income taxes for say 2023 should be a line item on your income statement, on your reviewed or audited financial statement, that says income taxes.
Okay.
On the budget for the CMI associations, I believe there's usually some kind of a account 7465.
Right. So
Yeah.
so during the budgeting process, you can see it there too, right? When the budget.
Yeah, so it's taxes, license fees, and audits is the line
Okay,
item that we
yeah, it's
use
in the-
for
yeah.
taxes.
Okay,
So it might be
7465.
included, yeah, in that line item.
I'll go and pull up last year's December 31st and I'll go and take a look and see where it's at, okay?
Yeah, or you can go into the general ledger, right, the details, if it's included in taxes, license fees and
Yeah.
audits, you might be able to see the tax that's owed and paid out of there.
Okay,
Okay,
all right, thanks.
great. Here's another fun question that we get. Is an expense an operating expense or replacement reserve expense? What do you think? What criteria do you use?
The reserve study.
There you go. If a if you're about ready to write a check for something and you go to your reserve study and there's a component, if you go to the reserve study, it's chock full of components, right? Those components are the basis for the suggested contribution into reserves, right? So we analyze each component. And so if you're writing a check for a component that you're saving for, right, in the reserve study, then that would most likely be a reserve expense. Now, there are some little gray areas if it's, if you've got roof in your reserve study and you got up and paid $500 to replace some shingles. Is that a reserve expense or a maintenance expense? I would probably say that's a maintenance, repairs and maintenance, right? Because the component in your reserve study is is a roof replacement or a layer, right? So, but generally speaking, if a major expense is in your reserve study, you have been saving for that expense, then it's a replacement, a reserve replacement expense. So does that make sense? If it's not, then you go to that's plan A. If it's not in the reserve study, then you go to plan B. Because if you have a major expense, you've got the check in front of you and you're wondering how to code it, and it's for an expense that should have been in the reserve study. Maybe they missed it, right? So if that's true, how can we pay for it out of reserves, even though it should have been in reserves? And what I advise our clients, with the help of knowledgeable association attorneys, is that this reserve study is a living document. It's updated every year, right? But it doesn't mean you can't update it during the year. So I suggest you have a board meeting and make a resolution to add that component to the reserves. If that, at that point, right after you make that resolution, is that expense component in the reserve study? And I would say, yes, it is. And it's going to be there when you update the reserve study next go around. Okay. At that point, I think you can pay for it out of reserves because it should have been there all along. Terry, what do you think about that analysis? You like that?
Sure.
Terry, are you on board?
I'm on board. One item though is, associations should keep in mind that if you are having a capital purchased, such as something you've never had at the association before,
Mhm.
it's something new.
Ah,
Uh,
good.
Generally, your governing documents are not going to call that, uh, they're going to call that a capital purchase.
Improvement.
Capital improvement, yes.
So maybe the association never had walls around it. But we want to start, there's a freeway coming by or something, and you're going to have a cement walls around and keep all the sound out. That is a new component. It's fine, and it's a good idea, of course, to, add that to the reserve study. But an additional expense like that would not qualify to be paid out of reserve funds. That would
Right.
probably take like a special assessment of the owners, or if it doesn't cost that much, maybe if you have a little bit of wiggle room in the operating budget, maybe you're just going to put some smaller things in. But yeah, something that's not already a component of the reserve study would not qualify to be paid out of reserves initially.
And many, I think almost all CCNRs have provisions that if it's over, say, $10,000, then it has to go before a vote. You just can't pay for it out of operating.
Mhm.
That being said, you can pay anything out of operating, right? It's just what this discussion has to do with, what can you pay out of reserves? And so I hope this discussion has helped. Any other questions about reserves and expenses and that type of thing? If not, you want to say anything more about board control bank accounts? That can be an issue, can it? Can't it?
Yes, it's, we only see these at the end of the year,
Right.
but especially if you have, if it's an active account, maybe there's expenses coming out of it or interest that's being earned with these accounts. It's really important to have the statements to CMI so that everything can be recorded every single month. Otherwise, the reports every single month are not going to include potentially significant expenses or interest income or anything like that. Additionally, everybody trusts everybody, but maybe one person gets this statement at their home address and they don't forward it to CMI. There's a risk that person could just be hiding things, maybe writing checks and then maybe hiding it in the statement, or you never know. Everybody here is very, very honest, but in order to correctly report the balances for your cash accounts every single month, those statements that are received from the bank and all of the activity on the accounts needs to be recorded monthly. Additionally, even for reviews, even if we don't confirm cash with the banks, for reviews, we want to see a copy of the statement. And so that needs to come to CMI so it can come to us. Yeah, you don't want to wait till the end of the year to have some big giant adjustment. Timely as well. So if a CD, this is the one thing that's hardest to get. If you have a CD or other investment type situation like that, banks sometimes all they give you is that initial notice. And so that's the only statement that you have. But I've never known a bank that you can't just, as the signer, say, we need to know the balance. Would you either email that to us or, email me some kind of a statement, or maybe you could just run in there and get something from the bank for a review. That's all we would like to see. And yeah, but mainly timely statements, timely things to CMI so that everything can be recorded.
Years ago, I was reviewing an association that hadn't had a review for a long, long time. And so I'm piecing together, years of financial activity. And all of a sudden, cash was just not working out. It was off by like $50,000. And I'm going, wait a minute, where could $50,000 have gone? Come to find out, a board member 3 or 4 years ago set up a bank account, board controlled, and just when he got off the board, things got lost accounting wise. And so they didn't even know they had $50,000 out there. We contacted the board. It's one of those accounts where it automatically, everything was added, interest added to the account, and just at maturity date, it just rolled forward. So I haven't seen that lately because the community management companies are so good at their accounting. But it can get confusing at year end, right? When Carrie's putting everything together. And so better to get that to accounting at CMI.
That's like the association's version of finding a $20 bill in your winter coat.
Exactly.
Put it
Hero
away.
hack.
Put it away
I was
till
a hero. All right. And borrowing from reserves. The only thing I would say about that is, if you need money, where are you going to go? You don't have time to assess, right? Special assessment, you borrow from reserves. That, in my opinion, that should be like bells and whistles should be going off. But all borrowings from reserves should be approved via resolution. It should be talked about. We still carry, I think, at boards that are, when we issue a financial statement, we show a big due to, due from the operating to reserves. And of course, at that point, boards have to figure out how to repay that. And they're surprised. It's like, well, wait a minute. Not CMI clients, but these are other folks. And so I think it's best to really highlight any borrowings, and it's a red flag on a lot of different levels because budgeting might be impacted. There could be the need for a special assessment because surprises happen. So, Kara, what do you think about that? You're nodding your head.
Yeah, I completely agree with it. It should be part of your budget process to review and
Or-
see if there's anything that you need to do, and definitely looking at it on a month-to-month basis.
Exactly.
Just check and make sure that, you don't have any cash flow issues, or that, I mean, maybe you're, yes, approve this, but you got to also pay attention to how much you're spending and how that correlates to how much you're bringing in.
Yeah, we're going to talk about working capital in a sec, but Carrie, did you want to say anything more about variance analysis? Very important tool monthly.
Yeah, Kara did talked about that, but through this year, I know that CMI has some new accounting software, and they're using it so the accounts are set up instead of having a prefix. You have to, when you go in to approve the expense for payment, say, is it operating reserve or working capital? So I've seen a lot more like need to reclassify at the end of, during our review, a lot of adjustments. So I would say that the variance analysis is a great tool. If you have window cleaning in your operating budget for $5,000 a year and all of a sudden it's $30,000, and if nobody looks at those reports and says, what in the world, and then just looks into it, why would we have this? Then there's probably going to be a reclassification because a whole bunch of the ground level windows had to be replaced or something like that. So that variance analysis that is in your income statements every single month is a really important tool. When we're doing reviews, I mean, that's really the meat of the review is the variance analysis. So if boards look at that ahead of time and take care of these on a monthly basis, it makes everybody happier.
So we have a couple of minutes left. I'm gonna end this with talking about working capital. Working capital, loosely defined. So if you open your accounting text, it's going to be a little bit different than what I'm going to tell you. So I'm going to say this loosely defined. It's generally the amount of money you keep in your operating account, right, on an ongoing basis to do business. Don't you have to keep a certain amount of money in there to pay bills? Money comes in, money goes out. You might have an insurance a bill that happens once a year or other bills that happen once a year. So don't you have to maintain a certain level of cash in operating, right? I refer to that as working capital. One thing to pay attention to when you're budgeting is if your normal balance in operating is starting to dwindle, right? Every year it's getting less and less and less. I think you may stand the risk of getting to a point where you have to borrow from reserves, right? You just don't have enough money, even it could be a temporary type issue, but I would say one of the goals of good financial management is to not have to borrow from reserves. Are there any Washington associations in the audience today?
Yes, we do have a couple of them. Mhm.
Okay,
Here, we have a lot more. Yeah.
okay, so the Washington legislature last year passed this model CIRA Act that has a ton of provisions in it. Here's one of them. I'm going to read it to you. And it's effective January 1st, 2028. Unless otherwise provided in the declaration, any surplus funds of the association remaining after payment of or provision for common expenses and any prepayment of reserves. I don't know, what do they mean by prepayment of reserves? I think that's the reserve contribution, right? So after payment or provision of common expenses and any prepayment of reserves shall, in the discretion of the board of directors, either be paid to the unit owners in proportion to their common expense liabilities or credited to them to reduce their future common assessments. And I get that. Every year, if you have excess money in your operating account, you can either write a check to your members or you got to give them a credit the next year. So how are those associations going to build up working capital if they're low? Carrie, help me here. Who writes this legislation? That's what I want to know. So you're handicapped. I don't know. I guess you could, these are Washington, right? I guess you could have in your reserve study an operating contingency in reserves and build it up there. I mean, this is just, I understand kind of the concept. You don't want your bad old association, taking your money and building everything up and operating so they can have a big party down the road or something. But this is, I'm not sure what they were thinking when they passed this legislation. So, but that's the purpose of having some extra money in your operating account just so you can do business, right? So I think it's a good thing to pay attention to that. What do you think?
Yeah, I think that somebody needs to ask for clarification on that. I mean, you're going to year to year have a deficit or a plus. What if people don't pay, then what are you going to do for the write-offs, et cetera? So,
It doesn't even say if this is on the cash or the accrual basis, right?
well, Washington is on the accrual basis.
Well, that's true. They're supposed to be on the accrual basis. So that's true. Well, okay, I'm trying to take pot shots at this legislation.
Taking your frustrations out on a YouTube video.
So anyway, that's our presentation along with Kara's presentation. So thank you for having us. And Kara, you did such an amazing job in explaining the financials. So good for you. And Carrie, thank you for all of your expert wisdom.
Does anyone have any other questions?
I just have one, then I'll let you go. On the reserve study, which we just recently had a new one done. I've gone out and sourced things for a lot less than what the reserve study shows. And then David Schwint and his company, they send us a letter saying that I'm way off on my money on what we have in the reserves, according to what the reserve study shows, and which is fine and dandy. So I put together a spreadsheet for Mac. I sent it into him, but where does that go? Because we don't want you guys to think that we're, flying, under the radar, flying footloose and fancy free.
Right.
We do have bona fide people. The biggest one where you got beat up on is on the painting.